Welcome back, everyone. Today on the Carlson Show, we have an important update on two companies. Now, I will admit, as a content creator or YouTuber or someone that generally shows off my portfolio publicly, it's more fun to focus on the companies that are doing well. This year, I have a number of companies that are doing fantastic. In the tech category, Microsoft and Apple have both been enormous winners this year, going up 40% year to date. In the finance category, Intuit has been a massive winner. I bought into the company this year and it's up $9,000, around 30% year to date. Costco has been another big winner year to date. It's up 25%. I'm in the green by $12,000 on this company. Now again, it's always fun to show these companies off, the ones that are doing well. And that's what most people online like to do. They like to show off the winners. Well, in this episode, I'm going to do something different. I want to spend some time going over two companies that are not doing so well this year, and I believe they're not doing well for different reasons. VICI is a company that I have a concentrated position in. I've decided to put all of my real estate money into this one, and it's just not doing well. For example, if I flip to year to date, VICI's down 5%, around $2,600. So we're down 5%, including dividends being paid, on a year where the S&P 500 and the QQQ are both up big time. Well, what's going on with VICI? We're going to be finding out in this episode. Another company that is selling off this year big time is in the restaurant category. This one is Texas Roadhouse. This company was one that I was recently in the green by around $12,000. Now it's traded down to being in the green by only $5,000. In fact, if I flip to year to date, Texas Roadhouse is now only up 2%. It was up at one point 14%. So it's given up basically all of its gains, and now it's trading completely flat. Well, why did Texas Roadhouse trade down so much recently? We're going to be talking about that as well. So in this episode, instead of focusing on the winners this year, we're going to be focusing on the losers. Both VICI and Texas Roadhouse, I'll be giving a full update on each of them. Now, I want to start off with VICI, and before we jump into what's going on with the current stock price, I want to just quickly revisit why I purchased this company in the first place. VICI is a real estate company, meaning they owned land and they own buildings. They are not casino operators. The tenants that rent from them are casino operators. Now, I want to revisit the reason that I bought this company in the first place. It all started with a trip to Vegas. I visit Vegas frequently, at least every couple of years. We go for a couple days. And one of the times I was there was after the pandemic in 2021. I visited Vegas and I noticed that it was incredibly busy. It reminded me of how incredible these buildings are. If you look at Caesar's Palace, there's nothing enhanced about this photo. This is literally what it looks like in person. The buildings are massive, they're elegant, they're themed, and they're not replicable. You can't recreate these buildings anywhere else. These buildings right here are right off the Vegas Strip. This is where the Formula One race is going to be. Now, when I look at the actual construction of these buildings, we can look further. This is what the swimming pool looks like at Caesars. Does this look like the normal swimming pool of any hotel you've ever been to? Of course not. There's none other like this unless you're in Vegas. Normal swimming pools are boring, but not in Vegas. Everything is more elegant. Everything is over-architected, incredibly designed. It's all themed. It is unique real estate, and it's much higher quality than most real estate. Even their shopping centers. You have the four malls here. This is where Simon Property owns a shopping center within VICI's properties. We have here the entrance to it. And again, this looks even more impressive in person. It is incredibly high quality construction, not something that's cheaply made, not something that's easily knocked off. And even aside from the construction, it's again right off the Vegas Strip. I became so impressed with the properties that VICI owned that I knew I wanted to own a piece of this real estate company. When I found that this company was selling for a cheaper price than other real estate companies, that made me even more sold on it. Now, at the time, VICI only owned Caesars properties, but then VICI did another move. They further expanded their portfolio right on the Vegas Strip by buying another property called the Venetian. Now, the Venetian also has the Palazzo. That's another section of the building. They are connected, and it's right across the street from Caesar's Palace. Now, Caesar's Palace is big, but the Venetian is massive. It's hard to describe how huge this building is. The Venetian is one of, if not the largest hotel in the world, with over 7,500 suites. It has the largest amount of convention space of any hotel, and it has huge casino floors on the basement. This is one of those buildings where you can just walk around and almost get lost in because of the vast scale of it. And like all the other buildings around this area, they are elegant. They're constructed with incredibly high quality. On the outside and inside, the Venetian, of course, has the theme of Venice. You have the little boats going down the waterways and you can walk alongside them. They have it designed so when you're inside, it looks like you're outside. You're away from the Vegas heat of being in the desert, but you still feel like you have a lot of space. You're outside with a lot of room. If Caesar's Palace was elegantly designed, the Venetian takes it a step further. The inside of it is immaculate. There's some hallways that are, again, they're like pieces of art. They're just vast and huge. They didn't go for maximizing space, they went for maximizing the quality. When I heard that VICI was buying the Venetian for a 6.25% cap rate, meaning the yield they were getting on this property was a higher yield than most Home Depots and Walmarts, I became incredibly intrigued. Most real estate out there across the world is commodities. They're little boxes on the side of corners that have no elegance, no design, and are easily replicated. Tenants of those locations can easily pick up and move somewhere else. They are overall commoditized. These places in Vegas are no commodities. They are unique, they are one of a kind, they are irreplaceable. The tenants inside of them literally have nowhere else to go. They can only rent from that real estate owner from that location. The fact that VICI was getting a better deal and a higher yield on these locations than what most real estate companies get for commoditized commercial real estate, I thought was incredible. This was clearly a mispricing in the real estate market. VICI was getting the deal of a lifetime, and so were their investors. At this point, I was already sold. I had bought into VICI, the stock was at a cheap price, and I thought the management was doing a wonderful job growing the company. But they didn't stop there. They knew they had to reach bigger scale to get into the S&P 500 and to get a lower cost of capital. So VICI continued to diversify their portfolio with a mega transaction from buying MGM properties, all the physical real estate of MGM, which of course has properties like the MGM Grand in Las Vegas. MGM is another massive casino operator across the US. So VICI now owns Caesars, the Venetian, MGM, and many other places across the country. They are a large real estate company with a very concentrated portfolio and high quality assets. And the stock did trade up over time. From $25 a share, it went up all the way to $30. Then it went all the way up to $35 a share at one point. More recently, it started to trade down. In fact, this year, it's basically been on a trend downward the entire year. And I want to discuss why I think that's happening. The number one reason, in fact, I believe it's the only reason that VICI's trading down this year, has to do with macro. I don't think it has to do with anything about the fundamentals of this company. I think the trade down is entirely the macro environment. The way that you know that this is about the macro and not something to do with VICI's fundamentals is VICI doesn't have any issues fundamentally speaking. They're collecting 100% of rent. VICI's also improved their balance sheet to investment grade and their debt structure, making it easier for them to pay future debts. So again, I don't think the reason is fundamental or specific to VICI. I think this is a macro problem. And by macro, I simply mean that with interest rates going up, I believe that investors are looking to alternatives to VICI. For example, right now VICI has a dividend yield of around 5%. So if you're investing in real estate companies to get current yield out of them, then a lot of investors are shrugging their shoulders and saying that I can buy a 10-year treasury at 4.5%. So I take the additional risk of owning an equity, a stock like VICI, when I can just buy a treasury bond. Now, of course, there's other ways VICI grows, and they grow their AFFO per year, so it's not that simple of a calculation, but I believe that's what a lot of investors are doing. They're simply taking money out of fixed assets and real estate and yielding assets, putting it into the 10-year treasury. On a fundamental basis, VICI continues to be the top performing pick in real estate, outperforming all comparable assets. For example, here's VICI in yellow against the broader Vanguard Real Estate ETF. So that's an aggregate of all of them in blue. And then we have Realty Income Corp, VICI's main competitor, in red. VICI's outperformed all of them on a total return basis for the past 3 years. We can also compare VICI's performance against AMT. This is Chuck Ockery's pick. The American Tower Corporation is a massive REIT. And again, VICI's consistently outperformed it over the past 3 years. VICI has been the best performing real estate asset in the index for the past couple of years. So in terms of VICI right now, I believe it's a company that still has very strong fundamentals, but it happens to be in a category, real estate, which has been doing really poorly this year because of interest rates. I don't believe this is going to last forever. And I don't believe that VICI will underperform the S&P 500 forever. Last year in 2022, VICI trounced the S&P 500, performing 11% gains while SPY was down 16%. So I think having a flat performance this year is okay. Texas Roadhouse had a great start this year. It raced up 12%. The investors were getting good gains in it. And then more recently, it sold off big time. This is what it looks like. So all year long, Texas Roadhouse is doing really well. Same-store sales are growing. People are happy with the restaurants. Their pricing is doing really well. The leadership says that they paid off debt. They're doing buybacks. They're paying a dividend. All of this positive stuff. And then all of a sudden, Texas Roadhouse starts to go down. And it continues to go down on a steady pace, giving up its entire year's gains. Now, I thought this chart looked interesting because it seemed to match what was going on with a lot of other companies. Let's go ahead and take a look at Pepsi. Notice how Pepsi looks a little similar. Pepsi went up during the year, it flattened out, now it's starting to go back down. Pepsi's down 10% year to date. And a couple months ago is really when it took a turn for the worse. Let's go ahead and take a look at another company here and see if we see something similar. We have Hershey's. Hershey's went up again around halfway through the year so far, and then it started to trade down. It started to trade down even faster. Hershey's is down 16% year to date. We can look at Coca-Cola. Coca-Cola was flat for the majority of the year, and then suddenly, just a month ago, Coca-Cola started to trade down. We can also look at Domino's Pizza. This one was a bit more rocky. It's been more volatile, but noticeably last month, Domino's went down dramatically. It in fact dropped 9% in a single day. Now, all of these companies have something in common. They all sell food for you that's not healthy. That is the common link. Texas Roadhouse is not healthy food. Pepsi isn't. It's salty snacks. We have the Hershey's company here, which is, of course, a lot of sweet snacks. Coca-Cola, everyone knows that soda is not great for you. And then Domino's Pizza obviously is not healthy for you. So why are unhealthy foods, which consumers love, all of a sudden selling off? Well, we have one major drug we can blame. It's called Ozempic. Ozempic is a drug that makes you feel fuller for longer. It uses hormones to slow down the digestion from your stomach to your intestines, therefore making you feel more satiated, more full for longer, and your desire for unhealthy foods shrinks, causing rapid weight loss. And this drug has caused rapid weight loss. People that use this drug are losing a lot of weight quickly. And the Wall Street Journal's noting that this puts a target on specific companies. They say, quote, the Ozempic craze could put these companies on a crash diet. Specifically companies that sell burgers, steaks, fries, fried foods. All of the type of companies we're looking at. This theme of Ozempic scaring investors out of unhealthy food companies has gone as far as different hedge funds now shorting these type of companies. Short fast food credit because of Ozempic, Barclays says. So now investors are literally shorting entire industries because of Ozempic. And the craziness doesn't stop there. Analysts are now even looking at airlines, saying that they're going to be more efficient with fuel costs because people aren't as fat when flying on airlines. Because they weigh less, airlines will be more efficient. And on and on and on this goes. Now, of course, anytime a miracle drug like this comes out, every single pharmaceutical company wants to make their own version of it, and they are. We have Nordisk's Wegovy. This is the weight loss version of Ozempic. It's going to be in pill form instead of taking a shot, which will make it more palatable to a lot of people. And the sales forecast for this type of drug is incredible. Here's a chart showing what they believe the growth in sales will be. Up to $20+ billion in 2027. So they're forecasting astronomical exponential growth in the sales of this weight loss drug. And this is making investors a little concerned about these unhealthy food companies. What makes them even more concerned is a recent study that came out. A study was released this month showing that this drug helped reduce heart attacks and strokes. Now, because that study was released, companies that make medical devices like glucose monitoring systems and sleep apnea machines plunged in value. Developers of drugs for fatty liver disease, which is linked to obesity, have also fallen sharply. Expectations for this class of drug have gotten so big that investors are reckoning with a potential hit to even more industries linked to obesity. Some analysts are even starting to project that reduced cravings can moderately curb demand for fast food restaurants and packaged snacks. And that is where I believe this hit into Texas Roadhouse stock price is coming from. The reason this stock trades at $94 today instead of $115 is not because of valuation concerns, but because of the concerns of the macroeconomics of a healthier populace due to routinely taking this dieting drug. See, the thought process here is simple. People on these drugs are less likely to crave Krispy Kremes. And if they stay on the drug for years, their weight loss could help prevent all sorts of complications like type 2 diabetes. That could in turn mean fewer sales for things like insulin pumps, sleep apnea machines. And people who slim down could hit the cancel button on their dieting apps. So lots of industries related to this drug are getting hit as a consequence. So that's what we know so far. There is this new drug out that apparently is going to revolutionize all of the healthcare industry. It's going to change the entire dynamic of how people consume foods, and many people are going to avoid things that they previously did, like eat a lot of unhealthy foods, including Texas Roadhouse. So here we have Texas Roadhouse, Domino's, Pepsi, Coca-Cola, Hershey's, and many other great companies selling off as a result. Now let me just point something out that I've noticed over the past 5 years of investing. There's always something to be concerned about with every investment. It does not matter which one. I can pick any company and point out valid concerns. With Intuit, the concern was that they're reliant on TurboTax and the government's making their own tax software. Intuit's up 30% this year. As long as I've invested in Apple, there's always been concerns about this company, about the sales cycle being slower, about Apple not growing as fast as they should be. This one has turned into a big winner by holding through those concerns. Now, I'm not suggesting we should completely ignore potential threats, but what I do in these type of situations is I see it show up in the numbers. I need to see an actual hit in Texas Roadhouse that is directly attributable to this new drug to believe it's going to be problematic. Because right now, all of this is speculation. None of this is confirmed through data. Even the Wall Street Journal says that all of this is very hypothetical for now. Paying for the treatment of hundreds of millions of obese Americans would literally make Medicare insolvent at the drug's current prices. So the drug is far too expensive right now. It needs to get dramatically cheaper. And on top of that, with any type of drug that goes large scale, it usually reveals some side effects of the drug. In this case, there's already some tests showing potentially severe side effects. The weight loss drug may be linked to stomach paralysis, other rare but severe issues, study says. This type of information could deter other people from using the drug in the first place. So similar to VICI, I believe the reason that Texas Roadhouse has sold down this year has nothing to do with its fundamentals. So far, the company has performed really well. They've beat expectations, they've paid down their debt, they're opening up new restaurants, the leadership is great at what they're doing. There's nothing fundamentally wrong with this company, and therefore, I'm not selling. And if the stock continues to trade down on fears about something that is entirely hypothetical, I will start buying more into this stock. So even though many of the companies in my portfolio are doing well, I hope you enjoyed this update on the two of them that are struggling. That's my thoughts for now. I'll see you in the next one.